So let's just handle the earnings that we're going to start to get Friday. The different silos, net interest margin, loan growth, credit, trading. What's going to be the headline, do you think?
I think it's going to be weak revenue growth is going to be the story of the quarter. I mean, the whole market's looking like it's going to be a soggy earnings per share growth, and that I think I've seen some forecasts are expecting down earnings per share, mainly because this is a revenue issue. So with regards to the biggest banks, the more of an investment bank you are, the tougher the quarter's going to be. So, and I think that the line that jumps off at me is that we're forecasting a 40% decline in equity capital markets revenue year over year because of one, the markets were difficult at the end of the year, but mainly because the government was shut down and it was hard to get offerings off through the SEC.
Will the street see it as a one-off?
I think the street will. I think the street will understand that. And also, I even think of our own pipelines. I think the majority of what was planned for 2019 will still get done. It'll just get done later in the year.
All right. If we're truly in a new rate environment, do they need to guide down lower on net interest?
Well, I'll tell you what. So here's the story. In June of last year, June 8th was the peak for bank stocks last year. We were looking for 12% earnings per share growth for this year and for next. Third quarter, loan growth disappointed, cut estimates. Fourth quarter, take rate increases out, cut estimates. We're now at 7% for this year and next for earnings per share. And I think it's really all revenue dependent. I think the banks are doing a good job on expenses, and they're buying back a lot of stock.
Just wanted to ask you about something in the news today on bank regulation. The Fed is proposing a new regulatory regime for foreign banks that are operating here, making it a little easier for them, lowering liquidity ratio. Is that still the mood? Is that still what's going on?
Well, I'll tell you, there are two things. I think we're still going to get regulatory recalibration. And I know there are some folks, when they hear that, they say, oh, my goodness, we're going back to where we were to 06, 07. No. The amount of regulation we've gotten has been so extraordinary. We're just recalibrating, I believe, back to neutral in many. One of the biggest, I hadn't looked at that specifically, but one of the biggest changes at Dodd-Frank was to enforce American bank holding company rules on foreign banks. And that was pretty tough medicine, all coming at once. So I haven't looked at the specifics, but I wouldn't be surprised. But one other thing I would say on this, Sarah, is in the first quarter, investors should be talking about the widening gap between the European banks and the American banks. The European banks moved backwards in the quarter, in my opinion, and negative interest rates are devastating to the banking business. And you've even heard some of the regulators in Europe talk about it. The more negative interest rates you have, the worse the European banks are going to do. And many of them are earning still 6% on equity, where the American banks have been able to recover and move onward.
Yeah, double digits. Let's move back to the capital markets here. You mentioned equity capital markets. What about debt? Last year, end of the year, things were dead. Certainly in high yield. There seemed to be a lot of resurgence in the first quarter of this year. Is that going to be reflected in some of the numbers?
There are two things that happened. Number one is I've been looking more year over year at debt capital markets and issuance. It's about flat. When I look at the individual estimates, which I've reviewed, they're up and down 1 or 2%. But the trading is a different story on the marks. The marks that happened in the fourth quarter for anybody who's an owner of that debt was extraordinary. And we've gotten a snapback. So I think anybody who is marking debt at the end of the year is going to show a nice markup, just like they showed a big mark down in December.
Finally, is Buffett right that Wells should go outside the street?
I personally believe that Wells has a great franchise and for a long period of time has done a great job. I think there's a very good company embedded in Wells. I do think they need to take a big, bold step and think very carefully. It's more than just going outside the company. I think they really need to spend time on picking the right person, because I think if they can make some of these challenges get fixed in the public's mind, I think that there is a good story embedded at Wells Fargo.
We've got a huge deal. Nobody even talks about the SunTrust deal. It's funny. We finally got some of that consolidation people have been talking about for years, Tom. Well, you surprised it sort of came and went so quickly in terms of at least an investor consciousness?
Well, no, but I'll tell you, you're going to see more of it. And I think what's really interesting is this MOE type concept, which is low premium. So, you don't have a lot of bank stocks with high valuations who are buyers. Very hard to get the 30% premium that you might have gotten in the past. Right. You're going to see, and then the Crapo bill that came last year, there are 88 banks between 10 and 50 billion that have embedded consolidation inside them. There's going to be more consolidation, we believe, in that group. And I think these deals are likely to be less premium, where it's going to be highly accretive to both sides. We've seen some examples of that. You saw it in the SunTrust deal. But I'll tell you, David, too, scale is working. That is what's new in the last 18 months, is the big banks are on offense again, and scale is working, and the bigger banks are more profitable, and the smaller banks are going to have to decide what they're going to do about it.